You were on a few months ago and we chatted about the global economic recovery and some of the risks you highlighted to a V-shaped recovery. And it looks like some of those risks that you did highlight have actually come to the forefront at this stage.
Indeed, Stephen, good afternoon. Yes, at the time I highlighted the fact that the risk to this V-shaped strong recovery in the economy was all that the consumer needed to take over the growth spurt, because this government-induced growth just couldn't continue forever. And that's exactly the kind of slowdown we're seeing in some of the numbers right now.
And of course, we do know that quantitative easing is set to expire at the end of this month. We don't know yet whether there could be another package. In fact, we had Ben Bernanke, the Fed chairman, speaking in the US this week and not alluding to a QE3 as some might have expected. So why have consumers not picked up the baton, and do we need more government stimulus?
I think that consumers have become a lot more careful in their spending habits. They've learned a lot of lessons, and hence it is going to be a bit slow before they take it up. However, as soon as employment numbers improve, as soon as the housing market starts improving, there's a lot of ability inside the economy to improve now. Credit extension is exceptionally low, so it just shows that consumers can very easily start taking up some more credit and start spending as soon as they get a little bit more confidence. In terms of QE, there's always the debate, but the problem is actually that the Fed needs to go the other way. They have to start taking the oros out of the cool drink now, so rather than putting more of it in. So I think he's going to be slow to put more QE into the market.
What does this mean then for asset prices as that oros is withdrawn from the cold drink? What's going to happen to equities and bonds and other sorts of investments around the globe?
Central bankers have a very difficult experiment that they have to try now, something that's never been done before. They have to stimulate economic growth, but at the same time, they have to normalize interest rates, so rates have to rise. They also have to increase interest rates to start combating inflation. So this is a very difficult balance. In terms of asset prices, they are going to have to swim upstream. It's going to be tough. There will be some headwinds, but economic recovery will take hold throughout the markets. Corporates do have a lot of cash on balance sheets, so they can start investing a lot more. And so slowly but surely, equity prices, I think, will lead us out of this.
George, are you looking at this just as a pause in the recovery in that case and not as a potential double dip?
100%. We do not believe this is a double dip at all. For the market to go into another recession, we'd need a shock to the system. Just like in 2008, we had a major event in terms of this American housing market imploding and a credit event that followed. The risk that we have now is the credit events unfolding in Europe. But that is handled a lot better, and there's a lot more foresight. All the politicians are involved, so unfortunately our problems will possibly have to be solved by politicians. But there's no event on the horizon right now that's going to cause us to go back into a recession. Yes, we only see this as a minor slowdown in the economic growth path.
Well, then how would you be positioning yourself in the markets at this stage, given some of the headwinds you've just outlined, some of the risks that still are out there, and the hope that the consumer and the business is going to pick up the baton from the Federal Reserve?
Our chief strategist often sets out the economic pictures for us, and then he sketches this economy that's racing ahead like a Ferrari. I like to add to that to say that this Ferrari is going to have to drive on a dirt road. So it's going to be a bit of 4x4 action going ahead. It is going to be tough, but there are opportunities there. During periods like now when the market's very negative, very skeptical, this is an opportunity to start moving a bit more into the risky assets. Up to now, we've been exceptionally defensive. You can start taking off some of those defensive versus the cyclical plays and slowly but surely start moving more into the risky asset classes. Starting to like equities more and more. There's some opportunities in Europe especially. It might take some time to unlock that value, but there's definitely a lot of opportunity there. Germany is growing very nicely. So there's, in the equity space, definitely a lot of opportunities, and that is our favorite asset class still.
Well, previously you did say you liked equities with a bias to the international. Does that remain the case? So not necessarily South African equities, you might be looking for better value offshore.
Indeed, we are still predisposed to international equities, and that's based on a valuation issue. Emerging markets and South Africa as well is relatively expensive compared to the international peers. So hence we believe there are better opportunities internationally, and that also gives you the inherent rand hedge eventually should we have a problem in the rand.
And how about some of the local rand hedge stocks? Would you be looking at those as well?
Indeed, they're very popular in the portfolios at the moment. Also a bit of the resources are becoming quite cheap in terms of their historical standards. So yes, indeed, the local rand hedge stocks very popular.
Well, going international again and moving out of that defensive space, what sort of sectors would you be looking at? Which sectors do you think can benefit as we do see that recovery stop stuttering and starting to pick up again towards the end of this year?
Well, however crazy this sounds, but the financials, they do provide a good opportunity. But it's the industrial stocks. As the broader economy starts growing and lifting off and into the consumer space, that's where it's going to be. So it's really in the industrial space and slowly but surely moving into the discretionary side.
Just given the interest rate outlook and the inflation outlook, would you be steering clear of government debt?
We are not as negative on inflation as maybe many other players are, both domestically and internationally. You know, the longer that oil stays around this 110 level, then it starts working itself out of the inflation numbers. The food numbers have also started rolling over. It does seem to be quite cyclical, and hence we think the worst pain is probably out of the inflation picture as we stand today. So we're not that scared of inflation. But despite that, bonds are priced at synthetically low yield levels, and we consider the bond market exceptionally dangerous and risky at this point in time. The only space where we'll tread there would be in corporate credit.
How about South African government debt? Because our yields are significantly higher than you're seeing internationally, and we've seen inflows continuing to come into our bond market. Is that a space you'd look at?
We've had monster inflows into our bond market. In the beginning of the year, foreigners were net sellers of South African bonds. At one stage down to 10 billion, which they've sold. And in fact, they've bought that back plus another 30 billion in the last 3 months. So it's been an aggressive buying opportunity. But that is purely because of the fountain of free cash available internationally, all this liquidity sloshing around in the system, and a lot of that cheap money is just looking to pick up some yield. So the South African bond market, with a solid rand performance at the same time, has been a fantastic haven for those buyers. But it's that exact same buyers that makes me very, very scared and nervous on both the rand and our bond market. So no, I do not like the South African bond market at all.
Well, just give us perhaps your outlook for the rand, because as you said, that rand has been strong, still trading around 675. Some saying we could see it strengthen even further, depending on how the dollar plays out with interest rates in the United States. What's your view on the rand from here, George?
Stephen, I think you touched on it 100%. This is not a rand story, and if it is a rand story, it only contains those hot flows of international investors coming into our market. This is a dollar story. With QE programs going out there continually, still a lot of cash in the system, that has led to an erosion in the value of the dollar that seems to continue despite the woes that the European economy is going through and the debt situation there. The euro is still strengthening against the dollar, and the dollar maintains its weak bias. Whilst that's happening, commodities are getting stronger. That pushes the rand even stronger still. So indeed, nothing has changed for the rand to suddenly make it go weaker right now, except if all these hot international investors leave. But there's no reason on the horizon right now to see why that should happen. So if anything, yes, technically the markets is looking at the previous lows against the dollar. So yes, 650, 660 looking likely. But you know, 650, that's only 20 cents away where we are now. So I don't consider that a big move. The big move eventually in the medium term will be to the upside.